GOEV, ticker GOEV, and the company Canoo just suffered a 28% decline on the stock charts. And this is in pre-market here. It looks like the company has registered 52.5 million shares via a direct offering to institutions to help the company stay afloat. This is 52.5 million dollars worth of shares, actually, but it's pretty dang close because it is, it's 50 million shares at $1.05 a share. So again, 50 million shares registered, $1.05 a share. The stock was trading at 125 as of the closing date on Friday. It's now looking like after this registration at a discount of about 16%. The stock is now trading down about 28 to 30% because of the dilution that these additional 50 million shares bring. But also at the lower valuation is really a sign of stress for the company, right? So this is no surprise. We're seeing a lot of companies suffer massive stress in the auto space right now. This is probably the absolute worst time that you could have a financial crisis for the EV makers. They go through a lot of expenses to try to ramp their businesses. We know that Rivian loses $271 of gross profit, so in other words, gross loss of $271 for every $100 of revenue they have. So in other words, they're massively negative on gross profit. When Tesla was manufacturing the same amount of vehicles, about 7,000 vehicles, Tesla actually had a gross profit, not including EV credits, of $20. So in other words, they sell $100 of revenue, Tesla actually made $20. Rivian makes $100 of revenue, they actually spend $271. That's gross profit. I'm not talking about net. Both of the companies at that stage lost money net. But the point is, the cash burn at a lot of these companies, whether it's Lucid or Rivian or GoEV or Canoo, are absolutely insane. There's a reason why I made a video about 2 months ago talking about the coming bankruptcy of Rivian and Lucid. And basically I went through their balance sheet and said, look, these companies are going to have to raise a crap load of money to stay alive. And there's a reason why on this channel, without fail and consistently, I have been warning that you want to stay away from profitless companies. I understand that when the ocean rises and the stock market rallies up, all companies are going to do very well. And you're going to see big rallies in companies that are money-losing companies, like, for example, Bill.com. And they'll rally. But then what will happen when they actually have to raise money or their earnings come out? They plummet. Bill.com shot up from about $91 to about $132. I mean, think about that. 132 divided by 91, that's about a 45% share gain. What happened? They reported earnings, and then all of a sudden the stock fell 25 to 30%, which when you fall by that amount off of a higher number could potentially eradicate that full 45% gain. It's not one-to-one. Do the math and you'll see what I mean. But basically, the stock's basically right back to $91, $92. So you gotta be very, very careful of money-losing companies, especially companies like Canoo. Look at Canoo's revenue, folks. Look at Canoo's revenue on their own income statement for the 3 months ended 2022 or 2021. Oh wait, it's blank. That's because there is no revenue. They have no revenue. They just have R&D expenses and SG&A. It's basically just a business that's burning money at this point. In the 3 months ended September 30th, they burned $117 million with no revenue. In the 9 months ended September 30th, they burned $407 million with no revenue. That's on their revenue statement, and there is no revenue. So it should literally just be an expense statement. Usually we call it the income statement, but it should be just the expense statement because there is no income. When you look at actual operating cash expenses, you're at $329 million of operating expenses. This is the cash flow statement. And purchases of plant, property, and equipment of $88.8 million. And this is in the 9 months ended September 30th. You're burning $420 million in 9 months, which means you're burning about $50 million a month just to survive. So let's write that down for a moment, okay? Cash burn at GoEV, $50 million per month. It's a pretty old big cash burn, right? Well, how much cash do they have? Well, that's easy because it's all public. You go over here to the balance sheet. Well, oh dear, $6.8 million in cash. Ooh, restricted cash, $4 million. Ooh, that's $10 million of cash. How much inventory do you have? Oh, 1.2 million, so like none. Got some prepaid expenses, but those don't help you. How about liabilities? How much money and how many bills do you have due within the next 12 months? Oh, good Lord. Accounts payable of $96 million. Accrued expenses of $74 million. Oh, yikes. You have about $160 million of debts due. 170-ish, closer to $170 million of debts due within the next 12 months. So you have payments due of $170 million due within 12 months. You're burning $50 million a month staying alive. And you just at a basically 16% discount or tried to raise $50 million in panic money. This company is going bankrupt. This is absolutely bad. There is no hope here. And so it's no surprise that the stock is down now 32% in the pre-market. This is a zombie company. They have no hope of revenue, and it's no surprise that the company has plummeted. Now, they had a lot of hope when they were pre-SPAC, right? Pre-merger, there was a lot of hopium for them. A lot of hopium. But boy, oh boy, 2022 was not a year to bet on some of these companies. There's a reason why I repositioned in January of 2022 and got out of every single money-losing company. I do not hold a single share of a money-losing company right now. At least I don't believe I do. I'm pretty sure I don't. I'm pretty sure I sold everything. I don't know, maybe there's like one leftover share somewhere. But the point is, you don't want to be in a money-losing company during a recession. And if that's not blatantly obvious, why you don't want to hold a money-losing company in going into a recession, hopefully this video makes that more obvious. And so I think there's a really big risk in investing in companies like, for example, Roku that loses money hand over fist. I understand they've gone up a lot recently. Look at this. They traded at a low at the end of the year at $38. Now they're trading at $61. It's insane, right? It's intoxicating because the stock is up 60%. That's great. But guess what that does? All it does is prop the stock up so that when they need to raise money to survive, they end up diluting you. And you're the bag holder. That's what you got to be careful of on these suckers. You become the bailout mechanism in a recession. That is the point of the stock market. The point of the stock market is to provide liquidity for these companies. And guess what? In this case, the company didn't even do the share sale on the open market because they probably realized they couldn't get it done on the open market. They couldn't dump 50 shares on the open market, 50 million shares. So instead, what'd they do? They sold it to an institution that was dumb enough to take it at $1.05 a share. And now the stock is trading for 86 cents. So the losers who just made that bet thinking they were getting a 16% discount, for some reason think it's actually smart to walk into a bankrupt company and bail them out. Doesn't make any sense. So I don't know. I don't know what other kind of handshakes or what kind of shakes they got, but this sounds like a terrible deal. And this is a very, very big risk when you're looking at investing in a recession. You've got, like, even if a company misses revenues and their guidance isn't as good, what you want in a recession is a company that's kind of like Apple or Starbucks. Okay, Apple or Starbucks, what are they telling you? They're like, look, yes, growth is slow. It has slowed. We're trying to recover. We have issues because of supply chains in China and their problems. But guess what? We're going to get through it. Not only are we going to get through it, but guess what? We're going to increase our dividends. We're going to increase our buybacks. And we're going to use this as an opportunity. Whereas you look at a company like Lucid, and they're like, yeah, we're going to raise $1.5 billion because we need to be able to survive. Or you look at a company like GOEV, and it's like, yeah, we need to panic sell $50 million worth of shares because we're burning $50 million a month in cash burn, and we've got $172 million of debts due within the next 12 months. We got a lot of bills sitting on our desks, and we've got no money, and we have no revenues. So I don't know how much more obvious you can make it that in a recession you want to stay away from money-losing companies. But I don't know. For some reason, people keep speculating on these because, I think they have the greater potential of a greater run-up. But, boy, you better play them as a trade, but I would not want to hold any money-losing company right now. That's my shtick on money-losing companies. Gosh, I always get so worked up over these, man. I get angry. Like, why would you have your money in this? It doesn't make sense. The financials are so terrible. Look, I'm a fundamentalist at heart, okay? I do fundamentals. That's what I do, man. I do fundamentals. That's it. I look, sometimes I'll do trades. I shorted the dollar, I thought, at a great time. I've got great trade ideas. I don't pull the trigger on all the trade ideas I have. I plan to more, especially since everybody around me wants me to trade more because I do have a lot of ideas. But the point is, at heart, I'm fundamental driven, and that's just because when I started with real estate, it was all about the fundies, folks. It's you do not overpay for a property ever. That is the rule. You don't overpay for stuff. Fundies over everything.